Yo, what is going on, traders? It is the Master Coin here, and we are back with a brand new video. So you might be wondering, what are we going to go through today? What source has he got for us today? Now, so many people have been asking me, Kieran, how are you getting these huge risk-reward ratios? Kieran, how do you use the lower time frames? How do you enter based off these lower time frames? They're so confusing, is what so many people keeps telling me. So what I'm going to do today is I'm going to clear up all of the stigma about the lower time frames and how you can navigate and use them to maximize your risk to reward. Because look, when it comes down to it, your risk to reward is everything. It is the most important thing when it comes to trading. If you haven't got a good risk to reward, what you're essentially doing is you're fighting an uphill battle. I don't care what your accuracy rate is, right? You could be 90%, but if you have a negative risk to reward ratio, right? Let's say you're risking $1 to only make half a dollar. You're gonna make things very, very difficult for yourself. So what we're gonna do in today's video is we're gonna debunk everything about risk to rewards and show you guys an exact blueprint which is gonna help you start to maximize these risk to reward ratios. Before we do jump into the video, I want you guys to understand that I do have a few more spaces in my mentorship program. So if you guys do wanna learn directly with myself and get some crazy trades and turn your trading journey around, then shoot me a DM on my Instagram. The link will be in the description. We'll hop on a call, we'll have a chat, and we'll see what's possible. But with that being said, guys, sit back, relax, and enjoy the rest of this video. With that being said, Master Coin out. So guys, what I want you guys to understand firstly is the importance of risk to reward and why it is so crucial for our trading success. You see, so many people focus on pips, right? Oh, I caught 100 pips, 200 pips, 400 pips, 500 pips, but they fail to realize that your pip count is completely irrelevant, right? And that's the first thing I want you guys to understand. It doesn't matter how many pips you catch, because if you're catching 100 pips, let's say, and you're risking 100 pips to catch 100 pips, that means you've got a risk to reward of a 1-to-1. So if we just quickly go down to the whiteboard here, so I can illustrate, right? If you're risking 100 pips and you're now looking for a 100 pip gain, that means your risk to reward ratio is a 1-to-1 because you're risking the exact same amount that you're looking to gain. Some traders, they actually have negative risk to rewards where they may be risking 100 pips to catch 50 pips. I'm going to show you guys how crucial it really is, because look, if let's say we catch that same 100 pips, right? We have the same target, 100 pips gain. But if our risk now is, let's say, 10 pips, that greatly increases our profitability. What do I mean? Because now we have a risk to reward of 1-to-10. So let's say if you risked 1% on the first example, you're 1-to-1, right? You risk 1%. That means you're gonna make 1% if you win. Simple. However, on the second example now where we're risking 10 pips to catch 100 pips, if we're now risking 1%, our gain on this position would now be a 10% gain. And the beauty of having higher risk to rewards like this, it allows you to succeed without having a super high win rate. One big reason why I love having larger risk to rewards, and again, when I have larger risk to rewards, guys, I want you to understand they're not random. There's a very specific methodology which I teach in my mentorship, and exactly why and how we get those risk to rewards. So what I want to do with you now is show you guys the importance of risk to reward with different accuracy rates on systems. Now we're going to do a 10% accuracy rate, 20, 30, 40, 50, 60, 70, 80, and a 90% accuracy rate as well. Now we're not going to do 100% because, let's be honest, that is completely unrealistic. So let's test this with two different trading systems, right? Let's do one where we have a risk to reward, right? So RR is risk to reward of a 1-to-1. And we'll do another risk to reward which is my personal trading plan, minimum of a 1-to-10 risk to reward. And I just want to show you guys how profitable you can be once you start to implement this into your trading. So let's say now with a 10% accuracy rate on our trading system, with a 1-to-1 risk to reward, right? We're going to lose 9 trades because 9 out of 10 trades is obviously a 10% accuracy rate. So that means we'd lose 9% on our account, but then we'd gain 1% from our one winner, and overall our account would be negative 8%. So we're not profitable. However, if we now have a minimum of a 1-to-10 risk to reward, we still lose 9% on our 9 losses, but we now win 1 trade which gains 10%, and overall our account is plus 1%. Even with a 10% accuracy rate. Now let's try that same system on a 20% accuracy rate. So again, with a 1-to-1 risk to reward, we would lose 8 trades, so we're down negative 8%. Then we win 2, which is plus 2%. So overall, our account is down negative 6%. So we're still not profitable even with a 20% accuracy rate on a 1-to-1 system. However, on a risk to reward ratio of a 1 to 10 now, we're going to be lost down 8% from our 8 losses. But we're going to make 20% from our 2 wins, and overall we're going to be plus 12% on our trading system. So even with just a 20% accuracy rate, you can make 12% profit. And I want you guys to really put this into perspective, the power of even having 12%. Let's just say now you're doing 12% a month. Imagine now you're trading on an FTMO account. Imagine now you're trading on a much larger account. 10% a month, 12% a month puts you in the top 5% of traders in the world. So you can clearly see, right? We can be very profitable losing the majority of the time. Now, just for the sake of time in this video, I'm not going to go through all of the others like 30%, 40%, 50%, 60, just because we can clearly see the result. But what I'm saying is, to be break even with a 1-to-1 risk to reward, you need to have a minimum of a 60% accuracy rate, because if you're risking 1 to make 1 and you lose 5 trades, let's say, so if you have got a 50% accuracy rate and you lose 5 trades, you're down 5%. So you're down 5% because you lost 5 trades, right, on your 50% accuracy rate. And then you win 5 trades, well, that's just going to negate it and you're going to be back at break even. If anything, you're going to be in a loss because of your commissions, your spread, your swap fees, and all these other fees that you have to pay when you trade. So even with a 60% accuracy rate, you become slightly profitable with a 1-to-1 risk to reward. So you lose 4 trades, so you're down 4%, you win 6, plus 6%. Overall, you're positive 2% on the account. Now again, that's not going to be 2%, because don't forget, you got your spread, you got your commissions, and all your swap fees that you have to pay as well. So realistically, that may even be 1%, or maybe even be a break even. So what I'm saying is, guys, by having larger risk rewards, now again, when it comes to having larger risk rewards, I'm going to show you guys on the charts how we can start to do that. But what you have to remember is, when it comes to increasing our risk rewards, we can't just randomly have targets. We have to have logic behind it, and we have to follow an entry model. Now, obviously in this video, guys, I'm not going to be able to go through the whole entry model and every single reason why and how we take the lower time frame entries, just because of time's sake. But obviously, if you do want to know more about how we can do the lower time frame entries, shoot me a message on my Instagram and we have to go into more detail on that. But how do we actually get these higher risk rewards? How can we do it logically, rather than just going on the chart and just randomly saying, oh my God, right, I want the market to go to this low? You see, I'm in this trade right now. I'll put the screenshot up. You can see the entries. It's currently floating a 1 to 69 risk reward, because we have a 4.3 pip stop loss, and we're currently floating over 296 pip profit. So what this means is, whatever you risked, you'd currently be up 69 times that initial risk if you held full volume. Now, we're not going to speak about volume and how much volume you hold. That will be another topic for another video, for a whole trade management series. If you guys want that, let me know. But how is it we managed to do that? Because I didn't just go down to the 1 minute time frame. I mean, this trade was, yes, 100% executed on the M1 time frame, right? So I'll go and show you guys where we entered and how we entered it. But we can't just stick to the 1 minute time frame. We have to use confluence with multiple time frames. You see, you can't just come down to the M1 time frame and expect to be getting these massive risk to rewards with these tight stop losses. What you have to do is use confluence. And the first thing you need to do is you need to understand this one phrase: fractals, right? You have to understand fractals. Now, what do I mean by fractals? Let's go out of trading so we can understand what it is, and then we'll relate it back to trading. So if you look at fractals in nature for a second, all fractal means is the same pattern repeating itself over and over and over and over and over again. For example, in the shell, we can see it is literally the spiral constantly repeating and repeating and repeating. And this is what the market is. When you're going from the higher time frame, like a weekly, monthly, or daily, going down to a 4-hour, hourly, 15-minute, 5-minute, 1 minute, 1 second, or whatever time frame you're on, it is the exact same thing. Nothing changes. All you're doing is zooming in and zooming out. It's like going on Google Maps, right? I know we've done this example before. If we go on Google Maps, the weekly time frame would be like, okay, where am I in the world? I'm in Thailand. Okay, I want to go to UK. Very simple. Going in lower, you're seeing exactly what route and what direction you need to take. So now, if we apply that to the chart, and if we pull up something completely clean for a second, and if we just isolate a few areas of price, so for example, if we just look at this bearish leg to the downside, I'll just clear the chart really quick. So if we just look at this bearish leg to the downside on the daily time frame, or even if we scale up to a weekly, Right? On the weekly, it's just 2 candlesticks, just, you know, some bearish impulse. But we go to the daily, we're going to see more data, and we're going to see the same sort of trend in market structure. We all understand how markets trend. We have lower lows, lower highs, lower lows, lower highs, lower low, lower high, and this is obviously a downtrend until the downtrend's broken, and it then becomes an uptrend, which should now keep printing, you know, higher highs, higher lows, higher highs, until obviously it gets broken. And then once obviously this whole thing manifests, that's where you get your Wykoff schematics. But that's a whole nother convo for another day. So if we look at that now and we drop down, let's say, to the hourly time frame, within that same weekly 2 candlesticks, we can now see a whole trend start to manifest. And again, if we even go down to the M1, we can see even more trends within the trends. So if we go down to the M1, we can see even more trends within the trends. We're getting more and more data. So how do we utilize this? How do we actually use this to get higher risk rewards in our trading? First thing, what you got to realize is that the market will first break structure and give you changes of character, give you signs that the market is going to reverse on the lower time frame first. How the market works is it has a higher time frame momentum, obviously. You see, it's very similar to the ocean, right? Let's say you've got your ocean, you've got your overall tide. If the tide's, for example, in or the tide's out, that could be like using a higher time frame. And then within the tide, you're going to have your smaller waves. And then within your waves, you're going to have all of your little ripples. And within your ripples, you're going to have, you know, more and more smaller waves. So what we need to understand is how it works in the financial markets is that it will always give you the signs on the lower time frames first. It's never just going to come to an area and all of a sudden just drop for no reason. You got to understand that every move is very intentional. You know, these markets are governed by the bigger players, the bigger institutions, and these guys are the ones that physically move the market. And for them to move the market, it's expensive. You know, even on Euro USD, it costs over $1 billion to move it by 1 pip. So when you're seeing these currencies move hundreds of pips every single day, you know, tens of pips every single minute, every single second, there's so much money being flooded through the market. So, and that's happening for a reason. And what you got to realize as well is the market is a language. It's always communicating to you. So when you can navigate, and again, I'm going to touch on how to actually use the lower time frames and scale in and scale out in a second, but you've got to realize first that it's always going to break structure on the lower time frames first. So how do we actually now use these lower time frames and use the knowledge that it will break structure on a lower time frame first? How do we actually do that? Well, what you need to realize is you have to use a multi-time frame correlation, right? You can't just come to the market and again, just go to M1 and just all of a sudden say, oh my God, right, I think the market's going to go lower, I think it's going to do this. No, you can't just have some random moon target. The reason we had this target is stuff that I teach in my mentorship, but what you got to understand, it was very intentional that we had this target. There's reasons, there's logic behind it, which in this example, one of them was the fact that we had liquidity and equal loads there, and we were in a higher time frame POI. And because we're in a higher time frame POI, we can have the higher time frame target. You see, you can't just be on the M1 and having a moon target, like a 4-hour a daily target, just based on the entry on the M1. If you have a 4-hour zone, you can have a 4-hour target. If you've got a 1-minute zone, you can have a 1-minute target. So whatever zone you're playing inside of, that should be what your target is based off. Now, how we actually get the bigger risks rewards, the secret behind it is this. It is having scalp entries with swing trades. Scalp entries with swing trades. Now, what do I mean by that? So, for example, we have our higher time frame, right? Our 4-hour level. We have a 4-hour supply zone. We know it's valid because it met all our confirmations. Now, from there, what we can do is we have 2 choices, right? We can be like retail smart money. And yes, I said retail smart money. Just because people trade smart money concept doesn't mean they're not in the retail side of it. Because when you're just coming to the market now, and saying, oh my God, this is a bearish market structure, this is an order block I want to short, what you're doing is you're pattern trading. And that's how retail traders trade. Now, again, if it works for you, hey, it works for you. But again, I'm not trying to trade like the masses. I'm trying to observe the masses and do the opposite because we understand that the masses fail. So even if now, let's say you're just using this one time frame and we're targeting the same area now, our risk reward is going to be a 1 to 8. Now, hey, look, that's not bad. And of course, if you are into smart money concepts, you would understand that a 1 to 8 is, you know, pretty standard for smart money. Now, for me, on my trading plan, I would never take a 1 to 8. A 1 to 8, I'm not getting out of bed for that, mate. Even a 1 to 10, I ain't getting out of bed for a 1 to 10. How do we actually go ahead and do it? Well, what we can now do is scale in on the lower time frames, and we can actually wait for proof of supply to occur at this area. Now, what do I mean by proof of supply? It's seeing evidence this market is going to react from this zone. You see, instead of just blindly jumping in on the higher time frame, shorting it, and trying to tell the market what it's going to do, what you can do is listen to the language of the market and wait for it to tell you if it's ready or not. Because truth be told, we don't actually know if this supply zone is going to be valid and it's going to hold. And if anyone sits there and tries to tell you, oh, this supply zone or this demand zone will hold, they ain't got a clue what they're talking about. So what we need to do is wait for that proof and let the market show us and tell us that it is going to actually go in that direction. You know, think of the price action like a hot plate. If your hands touch a hot plate, what are you going to do? Boom, you're going to move away really quickly, right? You're not going to hold on to it. And that's the same thing with the market. So instead of just blindly jumping in like an idiot, wait, have patience for the market to show you that it's going to reverse by giving you proof of supply. So if we now play the chart on, we can see that as the market is approaching our area, we have bullish market structure, right? Higher high, higher low, higher high. So why the hell would I want to be selling the market now on that higher time frame area like that when I've got the market in an uptrend? You know, I've got one time frame showing me that the market's to the downside, and I've also got one time frame showing me that the market's to the upside. So trying to sell the market in this area now with stops above the high is very, very low probability. Now, of course, if that is your trading system and that's how you want to trade, hey, look, if it works, it works. At the end of the day, let's be real. All right? The goal of trading is to make money at the end of the day. But again, remember, money is a byproduct of following your rules and following your system. If you can't stick to your system and can't stick to your rules, then you're not even a trader, you're a gambler, and you don't have any business in this industry. So what we can do is wait for that proof of supply. So again, look at this. This is a bullish market. We don't want to be selling right now, because if you would have, let's say, for example, now you're just coming in and just blindly now going, oh, just on the M1 time frame, you're saying, okay, this is bullish, right? And this is why we have to use a multi-time frame analysis. If we was just using a lower time frame, let's say, for example, a 50-minute, and we was trying to buy off, you know, this institutional candle here. Now, for me, I'm not going to use this institutional candle. What I'm going to actually use is this zone down here, because this is the refined level that we have. So even if, let's say, for example, right, use the refined level, or if you just use the larger level, which, you know, most smart money educators teach, which I absolutely despise, right? And you're having targets right now, you're saying, oh my god, right, that's bullish, so I'm just going to have a moon target, and you're trying to force the risk to reward. This is what you do not want to do. You don't just want to come onto the lower time frame, just buy it, and then say, oh my god, I want to have a super moon target because I want a 1 to 30 risk to reward. Because if you do that without any other context, without any other logic, then that's what's going to happen. Okay, cool, maybe you made some profit, right? Okay, but eventually, boom, you're going to get clapped out, because you need logic behind your targets. Remember, everything's very intentional, and this market is a language, and it's always telling you what it's going to do. But if we now correlate multiple time frames, because remember now, we have the higher time frame analysis pointing to the downside, and then we now go to our lower time frame and see the proof of supply, what we can now observe is that the demand has now failed in the market, because we was in an uptrend, and we understand that in an uptrend, each of these higher lows, demand is present, and demand is obviously causing the market to rally. How do we know? Because the only way the market will physically move is via supply and demand. Demand being buyers, supply being sellers. So if there's greater demand in the market will rise. But in this example, demand came in here. So this is basically our origin of our move. And we know it's valid demand because we obviously had an invalidation of this minus supply here. However, our bias is not to buy, because we know this is where sellers live. This is a higher time frame supply zones. We're not going to be trying to buy into it. We're going to stick to our narrative, and we're going to have patience. And then once we see the market trade below this area of demand here, we have now seen demand fail. And we now have evidence of supply in the market. So what we can now do is wait for the market to actually pull back and give us our entry. Because now what we can do, we can actually base our entry on the lower time frame. And because we're in the higher time frame area, and again, where was the entry? For me, I still didn't enter off that POI. And the reason I didn't want to enter just off that POI is because, again, look, the market became bullish as it was coming up. So personally, what I did is I waited for another demand failure, and then this became my supply zone now. And then from there, it was just a case of waiting for the market to come up at the right time, which it did. It triggered us in, and then we can see that we absolutely melted from there. And again, because we're now on the lower time frames and getting our entries based off the lower time frames, that's what's given us the smaller stop loss. The small stop loss comes from entering on the lower time frames, and the big risk reward comes from having the higher time frame target, which again, we're in this 4-hour leg, so we can have 4-hour targets. So now taking it down to this low, we can see that the market absolutely respects it, and that is now how we are getting the bigger risk to reward ratios. And again, you can't just blindly, like I'm not just going to come on here and blindly just try and target the moon or some random lows, because there needs to be logic. It has to be justified into why we're taking that position. So in conclusion, guys, remember, what you want to be doing is you want to be having a higher time frame bias and then scaling into that trade on the lower time frame after you've seen your proof of supply. Now, guys, that is all we have time for today, but if you do want to learn more, don't be afraid to reach out to my Instagram. Again, there's a lot of fake accounts going around. My only account is IK Davis, and if you do not hear my voice, it is not me. Ask to get on the phone with me. Ask to hear my voice, and I will send you one. So if you guys do want to obviously learn more and obviously want some personal mentorship, you can reach out, because I do have a few more spots in my mentorship program. But with that being said, guys, don't forget to comment, like, and subscribe. And if there's anything you want to see next, do not be afraid to let me know what you want to see, and I'll definitely get some content out for you guys. Also, guys, we're very close to 5,000 subscribers. Once we do hit 5K subscribers, I will be doing a very nice giveaway as well, so stay tuned for that. Share this with your friends if you got value. And with that being said, guys, I'll see you guys all at the top, from the top, because you already know, man, the bottom is way too crowded. Sheesh!